Spinning Circle, which means we're back for another Money Moves. Welcome, everybody. Welcome, Wendy Lee. How are you doing today?
I'm doing great. Like
Love it.
adjusting
Love
to
it.
allergies in the South, they kind of hit me this time of year, but
Yeah,
I'm
it's that
doing
yellow season. That's and for those of you that don't live in the South, that's when you walk out to your car and it's like yellow. I don't care what color it is, but it's yellow because of all the pollen. But not what we're here to talk about today. We've had quite a few questions recently coming in about life insurance. What's good, what's bad, and we're going to talk about the good, the bad, and the ugly when it comes to life insurance and why you should set up a kind of a multifaceted plan and what some of the gurus say and why they may be wrong. As far as well, we'll just leave it for the conversation. So do us a favor, show some love, click that little like button down below, and we're going to get started here in just a few seconds. And we're going to talk about life insurance, what you should know for your plan. So life insurance, everybody loves to talk about life insurance, right? But it's the key part of a well thought out financial plan, financial strategy. But so many times you run into people, and I don't know, Wendy, if you've ever seen the movie Groundhog Day with the insurance guy that's trying to track down Bill Murray and get him to buy insurance, and it's just that's what It's just like it's cringy, right? It's like and nobody likes to think about when they're not going to be here, but it's such an important part of the plan. And there's a lot of different choices out there. And you've got some gurus that are on the radio that say, you got to do everything in this bucket. And why I think that's a total, I'll just say it's misleading. Let's just put it that way, because there's a lot on the other side that we see when we talk to clients that are in their 50s and 60s that followed that advice, because some of those people have been around since the 80s, and now they're going, damn, I wish I would have done something else because some various reasons. So let's jump into kind of the most common that most people have, and that's the group life stuff. You get it through work. I got plenty, I don't need it. And I guess that's the question. How much do you need, right? What's the formula? Is there a formula out there? So, Wendy, what are your thoughts?
Yeah, we talk to people, right? Every time we sit with a client, we go through and ask what they have in life insurance or, disability, things like that. And I would say, like, more often than not, all people have is their group term. And
Yeah.
so through their work, and they feel like they're good with 2 times their salary, right? And,
If that, yeah, if that, a
yeah,
lot of times it's just the one times base salary, because that's a lot of companies supply that, right? Provide that through your work benefits. You can opt in to buy more, but I like you. I'm kind of surprised at how many people don't even do that. But you look at group life insurance, and that's it's something that the free stuff, take it, man. It's free, right? And it's added, insurance, but a lot of people don't even understand how much they need. They think, okay, well, I'm making, 80, 90 grand. That's plenty, right? That's going to pay off my bills. And it seems maybe, depending on where you're at in your life cycle, like a large sum of money.
right.
But there's a formula out there called dime, like a nickel and a dime. And so you add all those numbers up, and that's basically how much life insurance you need approximately. It's kind of a swag, right? But you look at, what does DIME stand for? So D stands for debts. If you're married, you got family, you don't want to leave the debts behind, take that opportunity to pay off your debts. So that's the D, right? And then the I stands for income replacement. That's the big part of it. And typically when I sit down with clients, I look at 75% of the income for a period of 5 to 10 years. If they're young and just starting out, no kids, 5 years. If they're married with kids, and hey, I've got plenty of responsibilities, that's going to be 10 years. And then empty nesters on the other side of it, that's going to be somewhere in that 7 to 8, in that, depending on their specific needs. But that gives you a good kind of range. So that's the I, and that's the big. And again, 75%, not 100% for 5 to 10 years. And that's for each spouse. So then the other piece is the M, that's mortgage. A lot of people overlook this, or they, have somebody knock on their door when they buy a house. They start getting all this solicitation for mortgage insurance. My opinion, don't buy it. It's crap. It's high priced term insurance is really what it is, and you can do something else with it and get your mortgage covered much cheaper. Typically, not all the time, but typically than you get in those mailers in the mail because you got to pay for that marketing. But you don't want to have that mortgage left behind, because you think about it and ask yourself this question: if you're listening, if something happened to my income today, could my spouse afford to keep the home? And Wendy, we see it all the time. And when it comes to kids, you got to think about that stuff, right?
Yeah. Yeah. And, to that same, token, you talk about that with maybe if there's one working spouse, and some people might think, oh, my wife is home with the kids. And so she doesn't need as much insurance. Right. But like,
Or any. I've heard
or
that
any,
before too.
if
Yeah.
something happens to her, I'm the one that makes all the money. I can still pay all the bills, but they're not thinking about that's a full-time job you've got in that household.
Yeah.
Run.
Yeah, ladies are stay-at-home husbands. Don't sell yourself short, man. And they need to understand. I always joke with that because typically it's the working husband, if you will, in a traditional setting, will say, well, like you said, she doesn't work, so we don't really need anything for her. And I'm like, okay, well, who do you want to have move in with you then? Your mom or your stepmom or your mother-in-law? Excuse me. And they kind of look at me funny. I'm like, well, somebody's going to have to come in and do all that stuff that they're doing because you're going to be working full time, and you're going to need to pay somebody to do it. And then all of a sudden the light bulbs go off. But not to mention, if you can't afford that home with one income and you got kids, the kids are going to lose a parent in that horrible situation, right? But they're also going to lose their entire safety network, their network of friends and family, because you can't afford the house, you're going to have to sell it and downsize. So that means the kids are going to get pulled out of school and go into the next school system or wherever, right? So they've got to deal with a stressful situation already, and then add the stress of moving schools and trying to make new friends on top of it. So that's the M. And then E stands for final expense. Usually about 10 to 15,000 is a good estimate. And then educational needs. If you've got young children or something like that, and you want to bless them with paying for college or whatever the case may be. So you add those numbers up, that DIME, and that tells you how much insurance you need. So let's go back to the group life stuff. So what are some of the pros of group life? And I'll have you name out the cons. So number one, well, it's cheap, right? And some of it's even free. If I can get 1 or 2 times my base salary, why wouldn't I do that? The other con is maybe I've got some health issues, so I couldn't qualify, on an individual plan. But all right, well, that gives me something. At least I've got something to help protect my family. Right. But again, go back to that dime formula and get as much as you can. But honestly, that's really the only benefit of a group policy for you, the individual. I mean, obviously, you're going to save cost because you're using a group policy. But if you're young and healthy, you're going to be paying for some of the older, unhealthy people, that kind of thing. So that's really the only benefit, right, to you, the pro. But what do you think some of the cons are, Wendy?
It doesn't go with you when you leave. That's a big one.
Renting insurance.
So, and it breaks my heart because people don't realize how important it is to get it young when you're healthy, because I was blown away. There was one time, you remember me calling you because the client said they paid $1,000 a month for term insurance. I'm like, they're saying that wrong, right? And you're like, well, how old is he? What's the situation? And you're like, no, that's probably legit. And I'm like, if you get insurance when you're young and healthy, it's a tenth of that, right? And so,
well, yeah, that's more on the individual term, but on the group term, that it's typically pretty cheap, and you're going to be able to get it as long as you're an employee.
Right. But my point with that, sorry, I didn't get to the point. The point with that is I think people think, oh, I have the group term, I'll get more term later. Right.
Oh,
and
yeah.
They lose their job or don't have their job anymore. That goes away. And now they're older and they have nothing. Now it's super expensive for them to get any kind of coverage.
Well, a lot of people are dealing right now with layoffs. You get laid off, guess what? That insurance goes away too. And now you're stuck in a situation where I don't have anything. I don't know when I'm going to get anything, and I've got a family, I've got kids, I got responsibilities, things like that. So it's a big concern. So that's the group life. Again, take it, especially the free stuff, and if it's cheap enough, treat it like gravy on top, though. But you don't want to just rent your insurance, your protection for your family. You want to have something that you own. Okay. And then we go into the world of term insurance or permanent insurance. And, permanent, there's a lot of different types of permanent. We'll get into that in a minute. But you look at the term insurance, and a lot of gurus out there say, buy term and invest the rest. Term is all you should have. And I'm telling you, that is a mistake. That is just a bonehead mistake. And if you've done it, let me explain why. Okay. And again, don't beat yourself up. You made the best decision you have with the information you had at the time. But here's why it's so critical. If you have term insurance, typically it's going to be at a maximum of 30 years. Okay. There is some other stuff out there for 40, but it's pretty unique and rare. So we'll just say, you're going to get a 10, 15, 20, 25-year, 30-year term. So if you're 30, great. I'm going to get that 30-year term, just starting on a family. I did this, that was what I was told back in the day. And so the thing is, you get that low payment, especially if you're healthy. Like Wendy just said, hey, I'm young, I'm healthy, I'm going to get it. But if that's all you do, and I know you think that 30 years is like forever, ever in the future, it will be here before you know it. And the gurus out there say, oh, buy term and invest the rest. Well, the problem is typically people don't invest the rest. Most people, what do? They go out and buy a truck or a boat, because they're looking at how much can I get for that low monthly payment? This is middle class. This is what we do, right? You buy a car. Well, how much is the payment? I'm paying it for 84 months, but I got a low payment that I can afford. Okay. So you got to look at what's the total cost and things like that. So for number one, term insurance, the reason it's priced so low is typically less than 2% of those policies actually pay out ever. Less than 2%. So you're putting that money every day and just going away and things like that. And 30 years later, you get nothing to show for it. Now, there are some that have what's called living benefits, that if something happens, you can tap into it. But let's just cut the chase, 2% or less pay out a death benefit. Okay. And the reason is people let it lapse. Well, a lot of people think, well, they let it lapse, but that's their fault, right? No, I'm talking about let it lapse because after 30 years, you can still keep the policy, but the premiums go through the roof. Right. Okay. So now here you are, 60, probably have some health issues, probably not in as good shape. So if you can even qualify for it at that point, you're going to run into what Wendy said, which was it costs too much now. Yeah. Right. Anything to add to that, Wendy?
Just reiterating what you said, the buy term and invest the rest. We talk to people all the time, and they're, like you said, they're not investing the rest. So it's a nice idea, but it doesn't happen.
Looks good on paper. Looks good on paper.
Yeah.
Right. So let's shift over. So should you never buy term? No, not at all. So the way I like to approach it when we talk to our planning clients, when we get to that insurance conversation, because you want to protect your assets, right? You want to protect your family. You want to protect your income. You can tie in some long-term care stuff into that too. And I'm not talking standalone long-term care. That stuff's expensive. I'm talking like riders and things like that. But having a foundation of insurance with the permanent insurances, okay? There's UL, there's index UL, there's whole life, there's several different, types of what I call permanent insurance. Some are good, some are great, some are which we'll dig into in just a little bit, but you use that as your foundation, okay? And you're not really using it for the insurance piece. Let me say that again. You're not really using permanent insurance for the insurance piece. You're using it to build wealth, another stream of wealth for you when you get later in life, another stream of income during your retirement years, right? There's a whole bunch of benefits to it. If you don't know what we're talking about, reach out to us. We'll sit down and walk you through what it could do for you. And we'll do that totally free, right? But going back to my statement, you have that foundation of permanent insurance, whatever the need may be. Now, that doesn't mean you're going to go out and have just permanent insurance. And I see a lot of insurance salespeople out there that, they set their clients up these big fat policies with a lot of coverage in there. And it's used, it's all permanent insurance, not really designed for any cash growth or anything like that. And they're paying way too much for it because they're not going to need all that insurance down the road. When the kids are gone, house is paid off, bills are paid off, your dime number goes down. This is why you have a foundation of permanent, but you augment it. You put the roof on your house, so to speak, in term insurance. So once that term insurance goes away in 30 years, you've still got that foundation of permanent that's going to last you typically to age 120. You're not going to make it to 120. Maybe. I'm not going to say never. But that way you have something to pass on to your kids, your grandkids, and everything else, some kind of legacy. And by that point, once you go into retirement, you typically stop paying for it if it's set up properly. So that's where that permanent insurance can come in. So you have that foundation of permanent. And I know some of the gurus out there, oh, all permanent insurance is horrible. They're wrong, just flat out wrong. And I'll explain the numbers. If you want to sit down and go through it with me, I'm more than happy to go through it with you. But going on a soapbox there, Wendy, what else do you have to add on that? What are the pros and cons of that permanent
Um,
insurance?
yeah, I mean, the pros, I mean, is that you can build that cash value, that you have that insurance to pass on, leave a legacy, cover, because guess what? You still have funeral expenses one day. And like I've lost all of my grandparents during my lifetime, and none of them had insurance. So their kid, and none of them really had wealth either. So all their kids paid for their funeral costs. And so it covers that. I think the legacy planning is huge. Like, not to get all into this today, but I've been fascinated by, like, we read that book with our book club, What Would the Rockefellers Do? And how to like
Yep.
leverage insurance to create generational wealth, which is so interesting. But yeah, the cash value piece, which you said, you made a key statement, if it's written properly, because we see people with those permanent policies that are written the wrong way. And the gurus, like you said, the reason they bash them is because they're like, oh, they're really expensive. They cost so much, but it's those policies that are written the wrong way.
Well, and that's exactly right. I mean, I'm working with a client right now. They're getting two, one with our company, one with another company. She said, "Would you mind looking at the other company?" And I went through it, and I'm just like, that was written for a commission.
Mm.
And so, sat down, explained everything to the client, and the light bulbs went off. I mean, it's all about the education, right? But again, having that foundation, now you go into, okay, the permanent insurance. Okay, let's talk about just that. So, you're not doing just group life, have it as gravy on top, right? You're not doing just term, have that to cover your big expenses in your younger years. And then, okay, that goes away. So that cost goes away. And you don't need to renew it and pay outrageous prices for it, because you still will need protection in your 60s and 70s, guys. Trust me on this. I'm not quite to that age yet, but I talk to enough clients. Then lastly is that permanent insurance. Okay, well, what do I have? How much do I need? Well, that's going to depend a lot on, number one, your dime formula. Number two, what are you using it for? Again,
Mhm.
don't necessarily want to have a big fat, permanent insurance coverage and a little bit of term, kind of 50-50 or 60-70 or 60-40, whatever the case may be. But it's going to be different for everybody. That's the thing. There is no silver bullet. But you look at, okay, well, what's this cash value all about? Well, those permanent policies actually grow cash inside. They've got mechanisms on how they grow, things like that. Well, they cost too much. Not really. If you look at the big face value of what does it cost, and we did a video on value versus cost. Go back and watch that, and all of a sudden the light bulbs hopefully will go off for you too. But if you look at the whole strategy, and there are a lot of people out there, and you hear the term infinite banking, and that's just a sexy way to sell insurance, right? And the whole life strategy is a fixed rate of return. Okay, is a fixed rate of return. Who determines that fixed rate? Well, not your bank, and we all know that banks don't really pay. Look at your savings account, right? But you look at the companies, and these are usually mutual companies, insurance companies, right, that pay a dividend. And if you look historically, and you can go out on the internet and just Google historical whole life dividend rates, what do these companies pay out? And it'll list top five, top 10. Over the last 20, 25 years, they've constantly just gone down.
Yeah.
And now we're hovering around 4 to 5%. Some are higher, some are lower, but on average, around that 4 to 5% range. Okay, so my money's guaranteed to grow every year about 4 or 5%. Okay, call your local credit union and ask what their CDs perform at. That's all I'm going to say. I'll leave that up to you. And I know there's some other pros and cons. I've probably triggered some insurance agents out there right now. My company, we offer whole life, that permanent strategy, but usually it's for a small guaranteed issue, kind of death benefit, for final expense and things like that. But from a planning perspective, and if you want your money to be steady Eddie, growing at a fixed rate, God bless you, do it. Okay. Then you look at the index strategies. Okay. These are ULs. I'm not a GUL fan, but an IUL fan I am. right? Why index? Well, there's a bunch of different indexes. I think 460 of them approximately.
Mhm.
And they all have, ups and downs. Some have caps, some have no caps, some have floors, some have higher floors. What you actually get is an indexed return. And some of these are indexed to actual markets, like an S&P 500, something
Right.
like that, right? Or the Hang Seng, or the Euro Stocks 50, or a blend of all those. What does that mean? Well, instead of a fixed rate of return, I get market returns. And some of them have no caps. So wait a minute, I get a market return and no cap. Why would I want to? That's the same thing as the market. Well, some of these index strategies have what's called a 0% floor. Okay. Meaning when the market goes below zero, you don't. Your money stays in there. Okay. And so these are just some of the concepts you look at. So, okay, I get the growth, but never the loss. I like that. And then just like whole life, the infinite banking guys, they always talk about the tax benefits, access to the cash and things like that. And again, that's looking at the pros of that, but the cons are still going back to I'm getting a crappy rate of return as opposed to a market return.
Yeah.
So again, me personally, I like the market return. You're going to get much higher returns, but you've got to look at how it's designed and what the product is. As I said yesterday, or I spoke to that client, they had a permanent strategy. It was an index strategy. Okay, check, check.
Yeah.
And then I looked at the actual product and the way it was written. Woo! No, it was written for a commission. The insurance coverage part was way too high. So the client was going to pay a bunch in fees. And that's where it goes back to, oh,
Yeah.
this gets a bad name. So,
Exactly.
of all of those, which one do you need? Do I need the permanent? Do I need the term? Do I need the group? Yes. Okay. Again, there's a blend. That's why it's key to sit down with a coach. And I know I went on a little bit of a rant there. I feel like I did all the talking today, Wendy. I'm sorry.
You like the
But
subject
it's
of it.
so here's the way you think of it, right? So you got your foundation is your permanent insurance.
Yep.
For those big coverage years, kids, mortgages, car loans, that's where you put the term on top. And then the chimney, the cherry on top is going to be your group stuff at work. Okay.
Mhm.
And then you kind of figure all that out and figure, okay, this is my total dime number. Let's blend it all in. But you want to have a blend of all these things, not just term, not just group, not just whole or permanent, type of stuff. Right.
Yep.
So again, that's why it's so key. Get a financial coach. If you don't have one, find one. If you want to work with us, don't hesitate to reach out. We'd love to help you. Do us a little favor. Give us a little like down below. Give us a thumbs up. Make a comment. I'd love to hear from you. If you've got a question or a financial topic you want to hear about, let us know, and we'll circle back with you. And hopefully, you'll hear your topic on the air. Anything else to add, Wendy?
Nope, just reiterate that. Get somebody to help you create a plan for you that is not tied to one product, like bottom
Yep.
line. So, and
Bottom
that's
line. Bottom line. All right. Thanks, everybody. Have a great day. We'll see you next week on Money
bye.
Moves.